Welcome to Breaking News to Trading Moves. We are looking directly at the headlines and figuring out exactly who stands to gain and who might be taking a hit.
Right. It is about connecting the news directly to the ticker symbols for you.
Absolutely. And we have a headline today that feels like a real clear escalation in the ongoing tug of war on Wall Street. We are looking at Bank of America, ticker BAC.
Right.
They are making a very specific, aggressive move into private credit.
Yeah, it's a $25 billion commitment. That is not just testing the waters. That is a serious allocation of capital.
Right, $25 billion. Bank of America is effectively saying they want back in. For the last decade, the narrative has been pretty consistent. Traditional Wall Street banks were stepping back.
Well, they were regulated out of the game.
Exactly, regulated out. While alternative asset managers really took over the lending space, it felt like the banks were becoming dinosaurs in that specific arena.
That has definitely been the prevailing wind. I mean, private credit has been taking market share for a clear reason, which is speed and flexibility. They can just move faster.
They often have lighter constraints than a regulated bank, right?
Yeah, much lighter. If you are a company and you need $1 billion for a buyout, you go to the private guys because they give you the answer in 2 weeks. But what we are seeing now with this BAC news is the counterpunch. The banks are trying to take that share back.
Because they want to keep the client relationships in-house.
And the fees. That is the critical part to remember for you as an investor. Think about the economics here. If a bank originates a deal, but then has to hand it off to a private credit fund because they don't want to hold the loan.
They lose out on the ongoing economics.
Exactly. They might get a small fee for setting it up, but the real money, the interest payments over 5 or 7 years, goes to the private fund.
Right.
So by committing their own capital, Bank of America keeps the deal flow and they keep the long-term income.
But there is another side to this story, isn't there? It isn't just about banks waking up and feeling aggressive today. There is some actual anxiety in the private market itself right now. We have to talk about Blue Owl, ticker OWL.
Yeah, this is the catalyst for the current mood. Blue Owl halted redemptions at a fund and actually sold assets to pay down debt. Now, to be clear, halting redemptions, or gating, is a mechanism these funds have to protect themselves.
Right, it prevents a fire sale of assets.
It does. But in the eyes of the market, it looks like trouble.
It looks like you can't get your money back.
Exactly. It highlights liquidity risk. It highlights sentiment risk for the whole space. When you hear that a major player is gating redemptions, it makes every investor pause and check their own exposure.
It just makes everyone nervous.
Precisely. So you have this specific moment in time where the alternative managers are facing some liquidity questions, and right at that exact moment, the big banks come in with their massive balance sheets to say, we are open for business.
Talk about timing, so let's analyze this. We always look at the winners and the losers. If Bank of America is bringing $25 billion to the table, who benefits?
We have to start with the category of money center banks.
Okay, so obviously Bank of America, BAC, but who else fits this mold for you?
You have to look at JP Morgan Chase, ticker JPM, and Goldman Sachs, ticker GASC. These are the institutions that have the balance sheet capacity to do this.
And the logic here is pretty straightforward.
Very straightforward.
Yeah.
It is about defending their turf. By doing direct lending, these banks generate more net interest income. But more than that, it is about wallet share. That is the term bankers love to use.
Wallet share, right?
If a private equity sponsor needs debt for a deal and the bank can provide it directly, the bank strengthens that relationship. They don't have to introduce a third party who might steal the client later on for other services.
So BAC, JPM, GS, they are flexing their muscles to keep the business entirely. But I want to push on that a bit. If the banks are stepping in with cheaper capital, does this mean the alternative managers are done? Like, if the banks are the winners, are the alternatives automatically the losers?
All of them. This is where we have to be specific and separate the pack. We have a category of winners we call alternative managers with scale.
So you mean the giants?
The giants.
Yeah.
We're looking at Blackstone, ticker BX, Apollo Global Management, ticker APO, and Ares Management, ticker ARES.
Why do they win if the banks are coming for their lunch?
Because the total pie of credit is growing.
Ah, okay.
Even if banks step in, there's enough demand to go around for the top tier. You have to remember, these players, Blackstone, Apollo, Ares, they have built massive origination networks over the last 15 years. They have ties to sponsors that go back decades.
And they have the product breadth to handle it.
Correct. They are too big to be pushed out easily. They have the scale to keep flows coming despite the bank competition. They can also handle the really complex, highly structured deals that a bank might still be too regulated to touch.
Right. The banks still have compliance departments watching their every move.
Exactly. It is the smaller or more sensitive players that have to worry, which we will get to in a minute.
Before we get to the losers, there is one more category of winners you identified: the referees.
Yes, the credit ratings and analytics firms. We are looking at Moody's, ticker MPO, and S&P Global, ticker SPGI.
This makes a lot of sense. If there is more lending happening, whether it is private or public, someone has to grade the homework.
Exactly. As issuance increases, the demand for credit assessment increases, the demand for risk tools goes up. And especially now, with some nervousness in the market regarding liquidity, investors are going to fiercely scrutinize underwriting quality.
They want a third party to tell them, yes, this is a safe bet.
That is it. That drives business directly to Moody's and S&P Global.
It's almost like a tax on the system. If you want to play the game, you have to pay the ref.
That is the exact dynamic. More volume just equals more billing hours for the ratings agencies.
Okay, let's pivot. We talked about the winners, but when capital moves like this, someone usually gets squeezed. Who are the losers in this scenario?
We have to go back to that liquidity anxiety we mentioned at the start. The first category of losers is sensitive private market managers.
And here we are looking at Blue Owl Capital, OWL, and Carlyle Group, ticker CG.
We mentioned the Blue Owl headlines regarding the halted redemptions. We call this gating. When a fund gates redemptions, it tells investors, you can't have your money back right now.
Which is terrifying for an investor.
It is. Structurally, they're allowed to do this. It is in the fine print. But psychologically, it is incredibly damaging.
It is the last thing an investor wants to hear. It's like showing up to the bank and finding the doors chained shut.
It hits confidence hard. And think about the downstream effects. If investors can't get money out, they are highly hesitant to put new money in. That raises funding costs for these managers.
Because they have to offer higher returns to attract any new capital.
Right, and it hurts the growth of their assets under management. And if assets don't grow, the fees don't grow.
So OWL and CG are facing a severe sentiment headwind here.
Yes. They are sensitive to these liquidity headlines in a way the massive players aren't.
What about the business development companies, the BDCs? These are publicly traded, so regular investors often hold them for yield.
This is where the bank competition really bites. We're looking at Ayers Capital, ticker ARCC, Blue Owl Capital Corporation, ticker OBDC, and Main Street Capital, ticker MAIN.
Why does Bank of America entering the market hurt them specifically?
It comes down to the raw cost of money. Think about where a bank gets its money to lend out. Deposits, checking accounts, savings accounts.
Which pay, what, virtually nothing? Maybe a few percent if you're lucky?
Exactly. Deposits are cheap. Almost free money for a bank.
But BDCs don't have deposits.
Right. BDCs don't have a deposit base. They generally have to borrow money from the bond market or even from banks themselves to lend it out. That is much more extensive capital.
So the banks can afford to charge a lower interest rate on a loan to a company and still make a healthy profit.
Precisely. If banks use their cheaper balance sheets to price loans aggressively just to win deals, spreads compress.
Spreads compress, basically meaning the profit margin on the loan gets much thinner.
Right. And for these traditional direct lenders, ARCC, OBDC, MAIN, that makes competition for sponsor-backed lending so much harder. They have two really bad choices. Either they lower their prices and make less money, or they hold their price and lose the deal entirely to a bank like JPM or BAC.
That is a terrible spot to be in. It's a pricing war against an opponent with bottomless pockets. Now, there's a third category of losers that might not be immediately obvious: the borrowers themselves, specifically highly leveraged borrowers.
We are looking at companies like Carnival, ticker CCL, and Charter Communications, ticker CHTR.
Wait, hold on. If there is more competition to lend money, like if Bank of America is throwing $25 billion into the pot, shouldn't that be good for borrowers? Shouldn't they get better rates with more lenders fighting over them?
For the strong companies, absolutely yes. If you have a pristine balance sheet, this is great news for you. You have banks fighting to give you money. But for the highly leveraged ones, the dynamic is entirely different. We are discussing a situation where underwriting overall might tighten.
What does that mean for a company like Carnival?
These companies are dependent on easy, constant refinancing. They have a lot of debt, and they constantly need to get new loans just to pay off the old ones when they come due.
Rolling the debt.
Right, rolling it over. If the risk premium rises, meaning lenders get scared and demand higher returns for taking a risk, These weaker credits face higher rates.
Or tougher rules.
Tougher covenants, yes.
Yeah.
So a lender might say, we will give you the money, but your debt-to-earnings ratio cannot drop below a certain very strict level. Or they might simply face reduced access to capital entirely.
So if the market gets volatile, or if the private credit funds pull back because of their own liquidity issues, what happens?
The banks might lend to the safe bets, sure, but they might pull back entirely from the CCL or CHTR type credits. That leaves those highly leveraged companies in a very vulnerable position.
So even though there is $25 billion of new money from BAC, it might not find its way to the companies that need it most desperately. It's a flight to quality.
That is the risk. The money chases quality, leaving the heavily leveraged borrowers completely exposed to refinancing risk.
I want to spend a minute on the mechanics of this move. We have the headlines, but how does this actually play out in the meeting rooms? What is the core strategy here?
For the banks, the strategy is a trade-off. They're chasing the fee plus spread opportunity. They want the upfront fee for setting up the loan, and they desperately want the interest payments over time. But by putting these loans on their own books, instead of just selling them off to investors, they are taking on credit cycle exposure.
Meaning, if the economy turns down and companies stop paying, the bank is the one left holding the bag.
Exactly. For the last decade, banks preferred to just arrange the loan and sell it into the market. That is the safe way to play. You get the fee, someone else takes the risk. Now they are keeping it. That completely changes their risk profile.
And for the alternative managers, the alts, how do they pitch against a bank that is offering cheaper money?
They pitch speed and structure. An alternative manager can sit down and say, I can give you the money in 2 weeks, and I won't put nearly as many rules on how you run your business.
Whereas a bank might say, we need 3 months of committee meetings, and we want to approve your annual budget.
Right. So alts win on speed and flexibility. Banks win on the raw cost of capital. That is the battle line right now.
But there is a watch item here, something that could upset this whole balance.
It all comes back to that liquidity sentiment. We saw it with Blue Owl. If we see more headlines about gating, or if we see signs of rising defaults, sentiment can crack very quickly.
And if sentiment cracks?
The alternative managers rely heavily on outside investors giving them money to lend. If those investors get scared, the flow of money stops entirely. That would force a repricing of the whole complex.
It seems like a very delicate time. On one hand, you have this massive vote of confidence from Bank of America putting $25 billion to work. On the other hand, you have real cracks showing in the liquidity of the private market players.
That is the tension we are tracking. BAC is betting that they can pick the good loans and use their balance sheet advantage to win. The market is watching to see if the liquidity issues at places like Blue Owl are isolated or if they are the start of a broader, more painful trend.
Let's do a quick recap for everyone listening.
Sure.
Headline: Bank of America, BAC, commits $25 billion to private credit.
Why? To capture fees and defend client relationships from alternative managers.
The winners.
Money center banks like BAC, JPM, GS. Large alternative managers with scale like BX, APO, ARES. And the rating agencies grading the deals, MCO and SPGI. Managers sensitive to liquidity fears like OWL and CG. BDCs facing intense pricing pressure like ARCC and OBDC. And highly leveraged borrowers like CCL and CHTR who face very real refinancing risks.
And the mechanism is banks trading credit risk for fees, competing on price against alts who compete on speed.
That is the summary.
I want to leave you with a final thought to mull over. We see the banks rushing in right now. Is this timing genius, or is it incredibly dangerous?
That is the question you have to explore. If banks are moving aggressively into private credit, just as liquidity concerns are hitting the alternative managers.
Are the banks arriving at the perfect time to steal market share when their competitors are weak?
Or are they catching a falling knife of credit risk right as the cycle turns against them?
Are they buying low, or are they just buying trouble?
We will definitely see how those defaults play out over the next few quarters.
A vital question for anyone watching these tickers, just a reminder before we sign off, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.